Your financial advisor just made you fragile. I need you to hear that again. Your financial advisor, the person you trust with your life savings, the one with the certifications on the wall and the expensive suit, just made your wealth incredibly fragile. And here's the thing that keeps me up at night. They have no idea they did it. None. They genuinely believe they're helping you. That's what makes this so dangerous. Let me tell you what happened to me in March 2020. I'm sitting in my apartment, watching my portfolio, $300,000 that took me 7 years to build, just vanish. Not slowly, not gradually. In 3 weeks, 40% of it was gone. I remember staring at my screen thinking, this can't be real. I diversified. I followed the rules. I did everything they told me to do. Stocks, bonds, real estate investment trusts, international exposure, the whole textbook playbook. And it all collapsed together like dominoes. Everything correlated to one, everything broke at the same time. But here's where it gets interesting. My friend Marcus called me that same week, and Marcus is laughing. Not like a nervous laugh, but genuinely amused. I'm watching my wealth evaporate, and this guy is laughing. He made money that month. Not a little, a lot. And no, he didn't predict COVID. He didn't have some crystal ball. He didn't get lucky with a meme stock. His portfolio was structured completely differently than mine. While I was optimized for average market conditions, he was positioned for chaos. And that difference, that fundamental philosophical difference in how we thought about risk, cost me over $100,000 and made him a fortune. That phone call changed everything for me, because I realized something that nobody talks about in finance. There are 3 types of things in this world: fragile things that break under stress, robust things that resist stress, and then there's this third category that most people don't even know exists: things that actually get stronger from stress. Your immune system works this way. Muscles work this way. And if you structure it correctly, your wealth can work this way too. The word is antifragile. It comes from Nassim Taleb, and it's the concept that Wall Street actively avoids teaching you because if you understood it, you'd fire your advisor tomorrow. See, traditional financial advice optimizes your portfolio for stability, for predictability, for the average scenario. But wealth isn't built in average times. Wealth is built in extremes, in chaos, in the moments when everyone else is panicking and your portfolio is structured to benefit from that panic. So let me break down what your advisor actually did to you. They took your money and they spread it across different asset classes: stocks, bonds, maybe some commodities, maybe some international exposure. They called it diversification. They told you this was safe. They showed you charts with smooth upward curves, and they said, look, over the long term, this always works. Just stay the course. Don't try to time the market. Keep adding money every month. And you believed them because it sounds so reasonable, so logical, so backed by decades of academic research. But here's what they didn't tell you. Diversification is based on a mathematical assumption that's fundamentally wrong. It assumes that markets follow a normal distribution. You know, that bell curve you learned about in school. Most outcomes cluster around the average. Extreme events are rare and predictable. The problem is, financial markets don't work that way. They never have. Markets have fat tails. Extreme events happen way more often than the models predict. Black swans aren't rare. They're regular. 2008 wasn't an anomaly. March 2020 wasn't an anomaly. These are features of the system, not bugs. Your advisor built your portfolio assuming the world is a calm, predictable place. They optimized for a reality that doesn't exist. And when chaos hits, when those fat tail events occur, your diversified portfolio doesn't protect you. It amplifies your losses, because everything you're diversified into suddenly moves together. Stocks crash, bonds crash, real estate crashes, commodities crash, your international exposure crashes, the correlation goes to 1, and you lose everything at once. I spent 6 months after that phone call with Marcus completely rebuilding how I think about money. I read Taleb's books, I studied option theory, I looked at how the best investors actually structure their wealth, not what they say in interviews, but what they actually do with their money. And I found something fascinating. The people who consistently build and protect generational wealth don't diversify the way your advisor tells you to. They use something completely different. It's called a barbell strategy. Imagine a barbell at the gym. Heavy weight on both ends, nothing in the middle. That's how antifragile wealth works. On one side, you have extreme safety. Not bonds, because bonds aren't actually safe in a crisis. I'm talking about real safety. Cash, treasury bills, things that genuinely can't go to zero. Then on the other side, you have extreme risk. Not index funds, not diversified equity exposure. I'm talking about asymmetric bets. Investments where you can lose a little but gain a lot. Options, venture capital, Bitcoin when it was actually contrarian, things with convexity. The middle? That's where your advisor put all your money. That comfortable, diversified, moderate risk middle ground. And that's exactly where you're most fragile. Because in the middle, you're exposed to all the downside of crashes without the upside of chaos. You lose when things break, but you don't win big when opportunities appear. Marcus showed me his portfolio structure, and I almost couldn't believe it. 80% in completely safe assets, things that would survive an apocalypse. Then 20% in what he called controlled explosions. High-risk, high-reward bets, where if they went to zero, it wouldn't hurt him, but if even one or two hit, they'd change his life. And here's the crazy part. Over 10 years, this structure outperformed my diversified portfolio. Not a little, a lot. And it did it with less stress, less volatility in his actual quality of life because he knew exactly what he could lose. Your advisor will never tell you this because their entire business model is built on assets under management. They make money as a percentage of what you have invested with them. If you pulled 80% into cash and treasury bills, their fee income would collapse. So they keep you fully invested in markets at all times. They tell you market timing doesn't work. They tell you cash is trash. They tell you you're missing out on compound growth. And all of that might be true in average conditions, but we don't live in average conditions. We live in pandemics and trade wars and banking crises and geopolitical chaos. We live in extremistan, not mediocristan. Let me give you a concrete example of what I'm talking about. In 2007, if you had a traditional diversified portfolio, you wrote it down in 2008, maybe lost 40, 50%, and then spent years recovering. You got back to even around 2012, 2013. That's 5 years of going nowhere. But if you had a barbell structure, that crash was the best thing that ever happened to you. Your safe assets stayed safe. Your small allocation to asymmetric bets, maybe some out-of-the-money put options, maybe some volatility trades, those exploded in value. You made money in the crash. Then you took those profits and you bought assets at the bottom when everyone else was terrified. You bought real estate at foreclosure prices. You bought stocks at generational lows. You didn't just recover, you multiplied your wealth. This is what anti-fragile means. You don't just survive chaos, you feast on it. And the beautiful thing is, this isn't complicated. It's not some secret hedge fund strategy that requires a team of PhDs. It's a simple structural choice about how you position your wealth. Safe on one side, asymmetric on the other. Nothing in the fragile middle. Now, I know what you're thinking. This sounds great in theory, but what about my retirement account? What about my 401k? I can't just pull everything into cash. And you're right, there are constraints, tax implications, employer matching, liquidity needs. But here's what most people miss. You don't have to do this with all your money. Even structuring 20 or 30% of your wealth this way changes everything. It gives you optionality. It gives you the ability to act when opportunities appear. And most importantly, it makes you anti-fragile in your decision-making, not just in your portfolio. Because here's the deeper truth that nobody talks about in finance. Being fragile in your portfolio makes you fragile in your life. When your wealth is tied up in assets that all move together, you become psychologically trapped. You can't take career risks. You can't start that business. You can't say no to the job you hate because you're terrified of disrupting your investment timeline. You need markets to cooperate. You need stability. You need the world to stay calm. And that dependence makes you weak. I see this all the time with people who have big portfolios but small lives. They've got $1 million invested, but they won't quit the corporate job that's killing them because what if the market drops 20% next year? They won't take 6 months off to travel or learn something new or spend time with aging parents because their advisor said don't interrupt compound growth. They're wealthy on paper, but imprisoned by their portfolio structure. That's fragility. That's what happens when you optimize for average conditions. Antifragile wealth gives you freedom. When you know that 80% of your money is genuinely safe, that it can't disappear overnight, you stop caring about daily market moves. You stop checking your portfolio every morning with anxiety. You can take that sabbatical. You can start that company.
You can tell your boss exactly what you think because you're not dependent on cooperation from the markets anymore. Your safe bucket protects you, and your asymmetric bucket gives you upside without risking your foundation. Let me tell you what this looks like in practice. After I restructured everything, I left my corporate job. I'd been thinking about it for 2 years, but I was terrified because my entire net worth was in market-dependent assets. What if I quit and then we had a crash? I'd be forced to sell at the bottom to cover living expenses. But once I moved 80% to safety, that fear disappeared. I knew I had 3 years of expenses that couldn't evaporate. I could ride out any storm. So I left, started my own thing. And yeah, the timing wasn't perfect. Markets were volatile that year, but it didn't matter. I wasn't dependent on them anymore. And the asymmetric side? That's where it gets fun. When you have a small allocation to high conviction, high risk bets, you start seeing opportunities everywhere because you're not trying to avoid risk, you're trying to find intelligent risk. Risk where the downside is capped and the upside is unlimited. I put a small amount into Bitcoin in 2018 when everyone said it was dead. I bought some deeply out-of-the-money call options on sectors I believed in. I angel invested in a couple startups. Most of those bets did nothing. Some went to zero. But the 2 that hit paid for everything else 10 times over. That's convexity. That's antifragility. Your advisor can't do this for you because they're playing a different game. They're optimizing for not getting fired, for having an explanation when things go wrong, for covering their ass with conventional wisdom. They'll never put you in a position that looks weird on paper, even if it's the right strategic move. Think about what happens when you go to your advisor and say, I want to hold 50% cash. They'll look at you like you're insane. They'll pull up charts showing how cash loses to inflation. They'll show you the opportunity cost of missing market gains. They'll tell you about dollar cost averaging and time in the market versus timing the market. And all of that is technically true if you assume markets only go up. But markets don't only go up. They crash regularly. And when they crash, cash isn't trash. Cash is the most valuable asset you can own, because it gives you the power to buy when everyone else is forced to sell. I'll never forget March 2020. I had friends calling me in panic, asking if they should sell everything. Their advisors were telling them to stay calm, to stick to the plan, to keep contributing to their 401k. Classic fragile advice. Meanwhile, I was buying. Not because I was smarter or braver, because I had dry powder. I had cash sitting on the sidelines that I'd been criticized for holding. And in that moment of maximum chaos, when assets were on sale at ridiculous prices, I could act. My friends couldn't. They were fully invested, riding their portfolios down, telling themselves it would come back eventually. And sure, it did come back, but they missed the opportunity. I didn't. This is the paradox of anti-fragile wealth. It looks stupid in calm times. Holding lots of cash when markets are ripping higher feels like you're missing out. Having a small allocation to crazy asymmetric bets feels reckless when your neighbor is bragging about his index fund returns. But you're not optimizing for looking smart at cocktail parties. You're optimizing for actually getting wealthier over a lifetime that will include multiple crises, multiple crashes, multiple moments when the conventional approach fails catastrophically. And here's something else your advisor won't tell you. The fees they charge are optimized for their wealth, not yours. They take 1% or more of your assets every year, regardless of performance. In good times, that might seem reasonable, but think about what that means over 30 years with compound growth. You're giving up hundreds of thousands of dollars so someone can tell you to stay diversified and not panic. That's an incredibly expensive comfort blanket, especially when their advice makes you more fragile, not less. I'm not saying all financial advisors are bad people. Most of them genuinely believe they're helping, but they're operating inside a system that rewards conformity. They pass the same exams, they learn the same models, they use the same software that spits out the same allocation recommendations. They're trained to think inside a very specific box, and that box is built on assumptions about risk and return that don't match reality. So even with the best intentions, they're giving you fragile advice because that's all they know how to give. The question you need to ask yourself is simple. Do you want a portfolio that looks good on paper and makes your advisor comfortable? Or do you want a wealth structure that actually makes you stronger, freer, and more capable of thriving when the world gets chaotic? Because it will get chaotic. That's not pessimism, that's reality. We've had multiple once-in-a-century events in the last 20 years. The financial system nearly collapsed in 2008. A global pandemic shut down the world in 2020. We've seen inflation spike to levels not seen in decades. We've watched banks fail. We've seen geopolitical tensions escalate. And this isn't slowing down. If anything, the world is getting more volatile, more unpredictable, more prone to extreme events. The fragile approach of diversifying into everything and hoping for average returns is going to break more people than it helps. I manage a 7-figure portfolio now using these principles, not because I'm smarter than anyone else, not because I have some secret information, but because I stopped listening to conventional advice and started thinking about wealth the way anti-fragile systems work in nature. I protect my downside absolutely. I expose myself to unlimited upside selectively, and I stay liquid enough to act when chaos creates opportunities. That's it. It's not complicated, but it requires you to think differently than everyone around you. It requires you to be comfortable looking wrong in calm times so you can be positioned correctly when things break. Over the next few videos, I'm going to walk you through exactly how to build this, the barbell strategy, in detail. How to structure the safe side so it's actually safe, not just bond fund safe. How to find asymmetric bets that have real convexity. How to think about career decisions and business opportunities through an anti-fragile lens. How to use the skin in the game principle to avoid bad advice. This isn't theory. This is the exact framework I use to manage my own wealth. But I need to be honest with you. This isn't for everyone. If you're looking for passive income tricks or get-rich-quick schemes, you're in the wrong place. If you want someone to tell you everything will be fine and you just need to keep dollar-cost averaging into index funds, your advisor will happily tell you that. This channel is for people who think philosophically about wealth. People who'd rather read Taleb than watch TikTok finance gurus. People who understand that real wealth isn't about following the crowd. It's about positioning yourself to benefit when the crowd is wrong. So here's what I want you to do. If this resonates with you, if you're tired of fragile advice that sounds good but doesn't actually work when it matters, subscribe. Drop a comment below telling me which part of your portfolio feels most fragile right now. Be honest. Is it that you're fully invested with no dry powder? Is it that everything you own is correlated? Is it that you know your current strategy won't survive the next crisis? Let me know. I read every comment, and I'm building a community of people who think about wealth this way. And if you want to go deeper, I've got an email list where I share insights I don't put on YouTube. More tactical, more specific. Link is in the description. I'll see you in the next video, where I break down the exact barbell structure I use. Let's build anti-fragile wealth together.